Big week for the markets. We'll get to a guy who, but you were bearish for a while. Jeremy Siegel, two-day meeting is going to kick off. Let's bring in Mr. Wharton, Jeremy Siegel, who you had the professor emeritus. Oh, we better say that at University of Pennsylvania's Wharton School of Business. We're going to preview the week, and it's unfair to call you a perma bull. You were bearish for a little while, but in your lifetime, if it was 800 in 1982, and we're now, where we are in the 30,000 plus, it paid to be bullish most of the time, I think, Jeremy.
Oh, it pays to be bullish long term all the time.
Right.
In the stock. Big surprise, I'm not in favor of Mike Wilson's prediction here.
You think we will rally? I saw that.
Yeah. I mean, I in a way, I say, thank goodness October is nearly over. Actually, in the last 25 years, I looked up the data. November is the second best month of the year, just slightly behind April, which is the first best month. So I do think we're going to have a year-end rally over here coming up. I agree with Roger Ferguson. I heard him earlier on your show. I mean, the Fed is certainly not going to do anything on Wednesday, and they're going to leave the door open. I think it's they're going to just say the evolving data. We still have 6 more weeks until the next meeting. There's no dots this meeting, so we don't know exactly what all the FOMC members are going to be thinking. But it's basically going to be a leave the door open. So I don't know if we're going to get all that much extra information as far as that's concerned. But I was looking at we're 10% off the low. We just entered correction territory for the S&P. We did it a few days earlier for NASDAQ. We're 15% off of that October low of last year. And I went back 50 years, and if that October low holds, which I very strongly believe that it will, returns in the market over the next 1, 2, 5, 10 years are very, very good. In other words, if you can invest 15% off of a bear market low, which is what we had a year ago, your subsequent returns have exceeded the market by quite a margin.
Yeah, I've seen people that have gotten 15% off a low, and then I can remember the actual individual himself. And at the time, I said, you know what? You just called it a multi-year low, and you're getting bearish 15% off the low. That's like stupid, right? And as it turned out, it did go much, much further. So you got to let your profits run, and 15% isn't that much off a low. Do you know what I mean?
Right. I mean, more persuasive than technicals or calendars. We're 16.5 times next year's earnings. And he talks about fading earnings expectations. Actually, 2024 is holding in better than historically as time goes on. Usually there's a phase. And, that 16.5 includes the Magnificent Seven. You get out of that and you're really at about 14 times earnings, 13. You get to the mid and small cap, you're 11 and 12. I mean, these are historical lows. Like we saw back in the 80s when, the 10-year was, 12 and 14%. I think we're pretty well near the top on the 10-year, maybe 5.25, but we're not getting up into those levels. And that's the only time that we really saw anything that was like single-digit PE ratios. Exclude that period of time in your 17, 18, 19, 20. So I think valuation is persuasive. I actually think growth is going to be better next year. And I, in fact, think that the higher real interest rates that we've seen is actually more optimism about growth in 2024. And that's going to pressure, the stock market because it has to discount those higher earnings. But I think those higher earnings are going to come through.
That's another thing, Jeremy. You would think there will be, debt will come due for companies and people that thought rates were never going to go up, and there will be some indigestion. But we're just getting back to what a normal rate of return is. I mean, businesses and people have done fine multi-year periods with interest rates where they are right now. This should not be choking off business expansion or business formation or anything at 5%.
Right. I mean, 2.5% is pretty much the average of what those 10-year TIPS bonds have been. Actually, when they were floated in '97, it was 3.5. They went up to 4.5 in 2000. And the stock market hit 30 price earnings ratio, double the level today, which I thought was crazy. And that's when I really, for the first time, turned very bearish there in 2000. But we're a world of difference right now with PE ratios half that number and real yields substantially below. I think we're
in the S&P. We haven't had a high in a while. We haven't had an all-time high in a while, and we've been consolidating and churning around. And maybe that you figure that happens next year.
I definitely think that does happen next year.
Okay.
Yeah.
All right. Well, then you could buy now.